Welcome to The Explainer. We're diving straight into a massive, silent revolution that's happening right now inside the world's most powerful financial institution. The Federal Reserve is quietly stripping away a vital tool that everyday investors have relied on for literally decades. Today, we're going to break down exactly what this sudden shift means, how Wall Street is scrambling to react, and most importantly, how you can navigate it. Because, look, the ultimate financial cheat code really is dead. For years, the Fed constantly telegraphed its interest rate plans. They essentially held the market's hand, feeding investors all this forward-looking guidance to keep everyone calm and prevent panics. But abruptly, under the new chairman, Kevin Warsh, that transparency is just gone. The Fed has stopped broadcasting their plans, leaving the public completely in the dark. So it begs the question, right? What actually happens when the masters of money go completely quiet? It's turning into a high-stakes financial mystery. And if we don't adapt to flying blind like this, our portfolios are basically parked directly on the tracks of an oncoming economic train. Let's look at some data to see just how drastic this shift really is. Which brings us to part one, the era of silence, where the Fed stops talking. The contrast we're seeing is honestly staggering. Back in the Jerome Powell era, a robust 27% of sentences at an average press conference were dedicated to policy guidance. But in Kevin Warsh's debut, a measly 5%? That's not a fluke. That is a purposeful, radical overhaul of how the central bank communicates with the world. And it's not just the press conferences. This exact same trend is bleeding into their written releases. Powell's meeting statements routinely clocked in at over 300 words. Investors were totally accustomed to dissecting these lengthy documents. Warsh's first statement in June? Barely 130 words. He bluntly acknowledged the statement was shorter, making it crystal clear he purposefully excluded forward guidance. He's actively starving the market of clues. This sudden blackout has absolutely triggered alarm bells across the financial sector. Take Alexander Morris, the CEO of FM Investments. He admits they built a highly profitable business out of decoding that jargon-heavy central bank communication, what everyone calls Fed speak. Wall Street built entire massive business models entirely on predicting what the central bank would do next. And now, Warsh just decides to go quiet, completely blowing up those old models overnight. Moving on to part two, the briefcase indicator and the desperate hunt for clues. To really understand the psychology of where we're heading, we kind of have to look backward. If you've been in the markets for a while, you probably remember the Alan Greenspan days. It sounds totally absurd now, but the market was so desperate for information back then that people joked a simple good evening from the chairman could spark a massive market sell-off. Financial media literally tracked a briefcase indicator. If Greenspan walked into a meeting carrying a bulkier bag, the working theory was that he had accumulated more evidence to alter borrowing costs. I mean, they were analyzing the thickness of a piece of luggage. And we are rapidly reverting back to an environment where every single breath the Fed chairman takes is scrutinized. Which leads perfectly into part three, the AI arms race. Wall Street flat out refuses to fly blind, so they're fighting back with artificial intelligence. FM Investments rapidly spun up a tool they dubbed WarshGPT, using Anthropic's Claude model. It cost them less than $1,000, took only 2 weeks to build, and it parses through nearly 1,800 historical documents and transcripts from Kevin Warsh. The whole point is to figure out exactly how his brain analyzes the economy, giving them an unfair institutional edge. And they are far from the only ones mapping out backup plans. UBS just built an interactive dashboard specifically to track Warsh's policy tone, noting his debut was overwhelmingly hawkish, which means he favors higher interest rates. Meanwhile, heavyweights like JPMorgan Asset Management are shifting their whole focus. If the Fed stops putting out their famous rate projection, the dot plot, JPMorgan plans to closely monitor speeches from individual company members instead. They're watching guys like Fed Governor Christopher Waller, treating him as a crucial bellwether for what the broader committee is actually thinking. So why spend all this money and deploy AI just to read the tea leaves? UBS strategist Elena Amoruso sums it up perfectly. She says this is arguably the most high-value data set in terms of how much one word can move dollars. Think about that. A single decoded word, or even just a slight shift in tone, can move billions of dollars across global markets in a matter of seconds. Part 4. A fractured financial market and the volatility ahead. When the market is forced to operate with this little information, people will try absolutely anything to figure out what the Fed is thinking. And less clarity breeds extreme volatility. Right now, CME futures traders are pricing in a 59% likelihood of a rate increase in September. They're betting heavily that a hike is coming.
But then juxtapose those futures traders with prediction market traders over on Kalshi. They are confidently predicting absolutely zero change in interest rates. That is a massive divergence. It just goes to show that this new shadow game has left the market completely fractured. Nobody truly knows what's coming next, which means we are guaranteed to see drastically bigger swings in the market.
Finally, part 5, the new rules of money and protecting yourself.
So what does this all mean for you and me? How do ordinary retail investors survive when we're competing against Wall Street supercomputers in this low transparency setup? Gary Richardson out of UC Irvine warns that it's going to become much, much harder for the ordinary investor. Institutions actually see this confusion as a huge opportunity to grab extra profit, or alpha. They have the frameworks and the AI to capitalize on the chaos, leaving the everyday trader at a serious disadvantage.
So you have to adapt your strategy. Here are the survival tactics you need right now. First, strictly control your own risk. Do not try to outguess the Wall Street algorithms that are processing thousands of transcripts a minute. You've got to diversify your portfolios to account for this massive spike in policy uncertainty. Build up those cash reserves, vigorously protect your downside, and honestly acknowledge what you simply do not know. True wealth creation in this new era of silence requires a deep resilience against sudden, unannounced economic shocks. So I want to leave you with this final provocative thought. As the central bank retreats into the shadows, is your portfolio resilient enough to survive Wall Street's new game? The rules of money have changed forever. The hand-holding era is officially over. Take the time today to review your financial defenses, truly understand the environment we're operating in now, and make sure you're prepared for whatever the Fed does or doesn't say next. Thanks for joining me for this explainer, and keep learning.